Let me throw up this chart to start with when it takes a look at factory gate inflation, which has been running pretty hot, and we aren't expecting too much of a moderation this month either. We saw very kind of muted moderation in the previous month. Does this potentially get in the way of market expectations of more easing from the government?
No, I don't think so. Actually, our forecast is also that the PPI inflation will stay elevated at around 8% in the near term. But if we look at the latest July Politburo meeting and the government overall sent a dovish tone, calling for more proactive fiscal policy, and also the monetary policy needs to ensure sufficient liquidity. In our view, that the PBOC will continue to maintain accommodative stance especially in view of the rapidly spreading Delta variants in China now to around 17 provinces, and also more signs of a slowing economy.
In particular, when it comes to the pass-through to consumer inflation, we haven't really seen that, right? Are the risks even more skewed to the downside, as you say, with the Delta variant and signs of pretty soft domestic consumption?
Indeed, the reason why, in general, the view is that the PPI inflation is not an issue, even though it would be trending higher in the second half of the year, partly reflecting base effects, is that overall domestic demand has been soft, and the PPI pass-through to the CPI will be very limited. And also the food inflation has been in contraction and dragging down the CPI inflation. That's why we are looking for a moderation in the CPI inflation this month.
We have seen already the likes of Nomura Holdings downgrade their third quarter GDP forecast for China. We've seen some forecasts also coming from Goldman Sachs as well, potential downgrades. Where do you see growth for China the rest of the year?
Yeah, we actually have downgraded Chinese growth in June, given our analysis that China's services as well as consumption will stay sluggish and subdued. And in the recent weeks, and we saw the Nanjing COVID outbreak quickly spread, and we did see the government escalated the restrictive measures and travel and quarantine and lockdown, and also closure of the indoor-outdoor recreation activities. So all these will weigh on services even more. And so we actually asked, by our estimates, that this latest outbreak could shave Q3 GDP growth by 1 to 1.5 percentage point. But part of that was already taken into account in our current forecast. So our two-year average forecast for Q3 is around 5.3%.
Right. And yet, the fiscal and monetary authorities in China continue to signal that they'll perhaps do more. How much of that downgrade can be offset by what's to come?
Yes, so on the fiscal side, we are all counting on the more local government special bond to be issued to support infrastructure investment. But we have to note that China's infrastructure investment has been running at around 3% in the past 3 years. So do not count too much on that to boost growth. And on the other hand, for the monetary policy, and we have forecasted another RRR cuts in Q4, and I think targeted policy rates to support the targeted area of the economy, support small media enterprise, support green financing, and supporting the manufacturing sector, and those are all, right, I think, possible.